Welcome to Real Estate Coaching Radio, starring award-winning real estate coaches and #1 international best-selling authors, Tim and Julie Harris. This is the #1 daily radio show for realtors looking for a no BS, authentic, real-time coaching experience. What's really working in today's market, how to generate more leads, make more money, and have more time for what you love in your life. And now your hosts, Tim and Julie Harris.
3, 2, 1, and we're back. And as promised, we are finally ready to present why there will not be a housing crash. And the title of today's podcast is, of course, Housing Crash Coming Soon. And if those of you who are not going to be listening to us for the whole half hour, the answer is no. You can get back to twittering or
see you later,
or whatever you were doing before. But for the rest of you, and for a majority of you, the tens of thousands of you who are listening to us now internationally, we are going to lay out the exact reasons, and we're going to present this content to you in such a way that you then can present the same information to your real estate customers. And if you're a broker or an office manager, or maybe if you're a content syndicator or whatnot, and you're looking for this type of information, please do use it, but please do credit it back to what Julie and I, as Julie and I as the source, because we've been working on this for a long time, and our content is copywritten, so no cutting and pasting and the rest of it. But for a majority of you who are real estate practitioners, this information is designed to instill confidence in your own business with regards to knowing that there is no crash on the near horizon, at least in our opinion, and we're going to give you the reasons why we think this way. But the main motivation for us doing this for all of you was so that you then could have the tools to present to your prospective clients in case they start getting a little bit janky as well. So we're going to go through these point by point, and Julie has spent a lot of time with the facts and figures because you guys like those types of, well, most of you like that type of information. And then we're going to post the notes for today's podcast on timandjulieharris.com. Whether it makes it over to iTunes and Stitcher and all the other places this show is syndicated, I'm not sure, but it's always, all of our long form notes are always living over on timandjulieharris.com. So Julie, overall, when you were creating these notes, and let's get to point number 1 here in a second, but overall, when you were going through all this, what was your, what were you learning? What was it? Did you approach this thinking that you were going to find reasons to believe the market was going to crash, or did you approach this? Did you have any biases when you were seeking this information?
I tried not to have biases.
Right.
I've tried actually to seek out reasons that perhaps it might crash.
Right.
Because, by and large, the overall evidence is that that's not the way it's going to go. And I always like to see, well, if we were wrong about that, why would that be? And so 100%. That was my motivation. And also what you said, so that they can talk with their clients and prospects. And also so that all of our brokers and agents can sleep well at night, not living in fear of something like that. And I think it comes in 2 forms. One is people who did live through it and perhaps did sell during those times saw a lot of crazy stuff, right? And it was a very dramatic, oftentimes depressing kind of market. And then you have another bunch, really a whole generation of agents and brokers who live in fear of the unknown because they didn't deal with it. So that's a lot of fear.
There's an interim group
anxiety.
Too. There's people that basically lived through the crash but never completely have gotten over it.
Yes.
And they've been holding themselves back for now over a decade, anticipating another crash. So they've not really fully committed to any aspect of their lives.
Not fully engaged.
They're not fully engaged because they're thinking to themselves subconsciously perhaps that, I'm not going to double down on my real estate business because I did that before back in 06, 07 and whatever. And I, suffered these pains as a result. So I'm in real estate, but I'm not in real estate as much as I could be, fully engaged. So we're going to go through these points, and I want you to listen to this information with an open mind. And Julie and I do constantly look for both sides of any argument because that's going to be the best. We don't want to be caught in any sort of confirmation bias either. It's inevitable, right? But here's the thing you got to keep in mind, and this is the thing that I think when you understand what I'm about to say is true, you're actually going to feel a lot more confident. The market, regardless of what direction it's going to go, it doesn't really matter. Ultimately, it doesn't matter for the sake of you helping people make money. Because if the market starts to adjust towards being maybe a buyer's market, let's say, it's going to be a relatively quick transition. But if that were to happen, you'd be able to make money then. If the market were to be worst case scenario, right? There's some sort of alien invasion and the housing market and the economy crashes, some sort of black swan event of all black swan events. Well, if that were to happen, guess what? You guys can make money then too. You're just going to have to adjust your approach, adjust adjust your skill set, and you're just going to, frankly, have to be a little bit more versatile in your mindset with regards to being of service to people. It might be right now you're being of service to people that are in a specific financial demographic or financial situation, and maybe that's where your niche is and you feel very comfortable. But all of a sudden that can be washed out from underneath you, and then you're going to have to quickly pivot, and you're going to have to then be able to adjust to whatever the market has to offer. And that's really the main thing I want you to remember. You have a real estate license. You make money whether the property's values are going up or the property values are going down. You still make a percent of the sale no matter what direction the market's going. And you can't say, well, a seller's market is better for the market or a buyer's market's better for the overall market. There's attributes and detriments of both markets, but I need you to understand, it's critical that you understand, you can be successful no matter what direction the market is headed. And what we're going to present to you right now is the reason that we believe that there's going to be no sea change in the market. And I mean this on a national scale, perhaps even an international scale. And we're going to go through all the points, point by point. Now, our crystal ball, right?
Yes.
Doesn't go any forward. It doesn't go any farther into the future than maybe 3 to 5 years.
I would agree.
And really, if we go beyond maybe even 24 months, then we're really throwing spitballs and just guessing. But we do feel comfortable that we're going to be in this cycle for the next 3 to 5 years. So without any further delay,
yes.
Julie Harris, let's just jump right in.
That's right.
Now, I know what you're about to say.
It's okay.
So here's your disclaimer. Lots of specific detail, lots of facts and figures. Julie's going to be reading you things that she found online, and these are in the form of bullet points. And again, we're presenting in this manner so that you then can be informed and we can kind of skip through the fluffery.
Yes, and just so you know how these podcasts are going to be laid out, this is a multi-part podcast series specifically about why we're not likely to end in a bust to the perceived boom here. Okay, so we're going to take one topic per day because there's a lot to this. There's not just one reason that we've researched. So today's topic du jour is all about lending. So let's kind of tee this up. Everyone is wondering if this is a boom that will end in a bust. Is this huge run-up in prices going to result in a massive adjustment? Well, it is a logical question, considering home prices are up a staggering 17.2% year over year. If you're comparing March 2020 to March 2021, that's an NAR stat.
And that's on national level, too.
Yes.
I hope you guys understood what Julie just said. The home prices in the United States, and by the way, have never gone up that much ever, not even during the housing boom. So they've gone up by over 17% in 12 months alone. And I don't know if you, I suspect you covered this, but everyone who was doing predictions in fourth quarter last year into the first quarter of this year about what the market was going to do, all of them were wrong. They all thought the market was going to level off and the appreciation was going to, or inflation was going to be less than 6%. Every single prognosticator was incorrect. The homes are continuing to inflate in value or appreciate in value at a similar clip than they did last year. We're seeing something that's never happened before.
That's right. And again, these rises in prices are historically even higher than the boom that preceded the housing crisis back in 2008. Now, Morgan Stanley reports home prices as measured by the S&P Case-Shiller Index rose 12.2% over the last year, with prices surging across all 20 of the metropolitan areas that is tracked by the index. Now, how does that translate into something real? Well, it amounts to an increase of $35,000 in the median selling price for homes from just a year ago and marks the fastest pace of increase since 2006.
Okay, so not fastest pace increase. Well, yes, frankly, the fastest pace increase of home appreciation or inflation. But what Julie just said is the average American homeowner has had their net worth increased by $35,000. So far, right.
Remember, it's only, these were based on through March, and now, we're in May. So it's even more than that.
So think about that. The average sale price in the United States, our average home value in the United States now is $350,000. Mm-hmm. So the average homeowner in the United States has already basically had their home increase in value by $35,000 so far this year.
10%.
Now, here's the thing that's really, again, we can go through monetary supply and get totally ahead of our skis and act like we know what we're talking about. We're going to keep it practical.
Yeah.
So here's the amazing thing that's happening. If you own a home right now, and this is the reason that it's okay to, essentially sort of ignore past sales and just, price things towards where the market's going to be. Because if you own a home right now and you're locking in one of these really amazingly low 30-year fixed rate mortgages, the increase in value through inflation or appreciation, whichever word you choose choose to use, is going to more than cover the cost of owning the home. So someone's going to be
When you compare it to the payment is what you're saying.
Right. So if you buy a $350,000 house, and I don't know what the payment is, but let's say it's $2,000 a month, and let's say with maintenance and upkeep and Mickey Mouse, it's $3,000 a month. You have to put a roof on it, or I don't know what. You guys get the point here. The house so far this year has already basically increased.
Paid for itself
For the entire year. So this type of thing makes owning a home. It's always been one of the best wealth creation vehicles for Americans. But oh my gosh,
I know, it's amazing. So we'll take a look at the reasons that this market is not going to be just like 2007 and 8. We're doing this again for your own education, as well as so you have specific talking points for your nervous buyers. Now, here's a fact. Here's a little coaching morsel. An objection is an unanswered question in the mind of the prospect. The unanswered question you're hearing now, or even asking yourself, is the market going to adjust, crash, decline anytime soon? So take good notes, get ready to sleep better at night, knowing the facts versus conjecture and speculation. Okay, so let's get to the nitty gritty. Reason number one, and that's what this whole podcast is going to be about. Mortgage lending is completely different than it was in the previous housing boom. There is far less mortgage risk now than there was in the previous boom. The subprime mortgage crisis was a leading factor in the housing crash. Not so today. Let's take a moment to compare and contrast because it really is amazingly different.
Are we going to be talking about the forbearances coming to an end? Okay, good. Mm-hmm. Well, you did a good job on these notes, lady.
Thank you. I appreciate that. Okay, so let's see. In 2005 to 2007, an average of 40% of mortgages were considered subprime. Now, we have a lot of listeners that don't know what that means, so we're going to get into that in a second. But these were loans which were used when people applying did not really fit into the conventional loan mold that you're all used to having to comply with today. Almost all of those applications would be declined in today's mortgage environment. So some examples, this is a little education piece. Some examples of subprime loans. Remember, back then, 40% of the loans were like that. Today, it's only 2%. So there's a big reason why things are not going to hit the fan. But
Jules, you went over that too fast.
Sorry.
So back in the crash, 40% of all loans.
The boom before the crash.
Right. The boom before the crash, right. Yeah. People were getting mortgages. And by the way, people were getting mortgages not knowing that they were subprime mortgages. A lot of the lenders were putting people in subprime mortgages because they paid them more commission, even though they could have qualified for conventional. So long story short is 40% of all new mortgages were subprime. So maybe some of those could have qualified for conventional mortgages, but a lot of them couldn't. And so with subprime, the details on how to go about getting a subprime mortgage back then will astound you.
Yes, so we're going to get into this. And I know that there's going to be listeners going, huh?
Yeah.
You could do that? Right? And as did we then. Okay, so examples of subprime loans. Interest only. That means you're never paying down the principal. You're only paying the interest. There was something called a ninja loan, which stood for no income, job, or assets. Try and get that to fly today.
Well, they didn't actually call it ninja. That's what the industry called it.
The mortgage people
did.
It was a nickname.
It was a slang term, really.
Yes, exactly. Yeah. Okay, stated income loans, and the slang term for that was liar loans. But you could just say what you made, and in other words, there was no employment verification. No documentation loans, or no doc loans, where you didn't actually have to paper it up like you do now, proving everything with every pay stub. And then a lot of 0 to 5% down payment mortgages, meaning you were walking into that house with no equity. Okay, and prices were rising, but not forever. So here's another fun fact: credit scores, debt to income ratios, job history, and down payment verification were all, shall we say, anywhere from optional to less important to simply made up or just not asked for in the first place.
And that's the thing that folks nowadays don't understand. Back in the run up to the bust, it was incredibly easy to get a mortgage. It was
pretty quickly too. There was no 60-day, you could close fast.
People didn't even think about it. I mean, you and I were living in Las Vegas at the time, and this was pre-Zoe, right?
Yes.
And I remember you and I were parking. We were going to see Jerry Seinfeld or something. We were parking our car, and we were talking to the valet. And long story short, he was giving us real estate advice, and he said he already owned 5 houses or something. Yeah. The dude was a valet. Now, valets in Vegas make, oftentimes you'll be shocked, but over $100,000 per year, but 5 houses. And so I remember Julie and I thinking to ourselves, well, that doesn't sound quite right.
No, something is going on here. Also, appraisals were not so regulated. Everything appraised all the time until it didn't. You didn't have these appraisal fights that you do today. Okay, it's the risk factor that caused the bubble to burst eventually. It was unsustainable risk.
Well, so basically, just long story short, we can round the bend on looking at history. What was happening is all these subprime mortgage companies, and the first one that failed was actually in Southern California. I think it was called New Century. I think right. It was, yeah. And when essentially these subprime lenders were taking all these loans, and the premise back in the day was that there's never been a nationwide housing crash or even correction. And there's never been a time when housing values had gone down more than a certain percent. And there were people that were physically in altercations arguing that there's no way there's going to be a housing crash. I'll tell you guys a really quick funny story. Julie and I were, we were in we were waiting in line to mail a bunch of Christmas presents when we were at the post office in Laguna Beach, California. Uh-huh. And there were two older gentlemen. It was a long line. There's these two older guys that are, and they were loud, and you could hear what they were talking about. They were both old-time Laguna residents, and they were literally arguing. One was saying there's never going to be a crash. Laguna Beach prices will never drop. And the other is saying this is going to happen, And guess what? They were starting to get really almost they were pushing each other basically over that. And, the thing is that the guy that was saying there was going to be a housing correction was correct. And the other guy was wrong. But that's how dug in.
Yeah, and I remember we went to an open house there, and just for fun, because that's what we do, right? And, the agent was yelling at us as we walked in the steps, are you going to buy it or something like that? And we're like, no, not for us. And remember what she said?
No, this is after. You're telling
the next time you see it, it'll be $1 million. And it was an $800,000 house. She believed that, it would keep on cycling up and up. And people just so wholeheartedly believed in it. So I wanted to do a little summary from Morgan Stanley because we need to make sure they understand this.
Well, just to finish the point, the reason that all these loans were getting originated, and the lenders were able to actually get these loans effectively insured by the government. And so the government was, these lenders were packaging these loans, and they weren't keeping them, they were selling them off. And that's the easiest way of explaining it.
This is the whole mortgage-backed security thing.
There's been a lot of really interesting movies that have been written about this. And actually one of our neighbors, Peter Schiff, was one of the first people to predict that there was going to be a housing crash. And, I've talked to him about it before, and I'm asking him what he's predicting now is going to be the next big crash. And guess what he told me? Cryptocurrency. Do with that as you will. Right. But in any event, the moral of the story here is that this is a very well researched historical time in the U.S. economy. And if you're wonkish at all, you should go back and study it, because the things that led up to the crash were all aggressively studied, and then every single one of the things that was enabled to happen. And in essence, these loans, the type of lending, the type of sort of culture in the mortgage industry was all addressed. And they essentially, when the new mortgage regulations came out and how the banks reacted with their own overlays on the mortgages, there is zero chance that anyone with any sort of even a remote tinge of flakiness in their mortgage application is going to get a loan approved. And it's been this way for a long time.
It has, but it's important that these guys understand that a lot of the stuff they deal with today is a result of what we're talking about now. And it's really good for you as real estate professionals to have this history in your brains. So I'm going to summarize this little piece, and then we're going to talk about specifically what's different today. So Morgan Stanley summarized it by saying these products, meaning these funky loans, were inherently risky because they required home prices to keep rising and lending standards to remain accommodative so that the borrowers could refinance their monthly payment before it became unaffordable. However, when home prices stopped climbing, these mortgages reset to payments that borrowers could not make, leading to delinquency and foreclosure because they could not then refinance out of it. As foreclosures and subsequent distressed sales piled up, home prices fell further, creating the vicious cycle. So that's kind of the conclusion of what was happening. Then we'll talk about how it's different.
But what happened? So the vicious cycle was this. People no longer believed the house prices could only go in one direction. So there was psychology that changed. And there was other things that changed after that as well. So once people realized that they have no equity in their properties, once people realized that they could move out of their house and rent the house 3 doors down, and their actual monthly payment was going to be less than what they're now paying on their adjusted mortgage, which they can barely afford, people would move to the new house. Sometimes they do what's called buy and bail. Mm-hmm. They'd buy a new house that was a lower payment that already had a reduced market price because of the fact that the prices had dropped. and they would then allow their old mortgage to go into default. There were all kinds of things that were happening. But the real important thing is what happened to the perception. Like when Julie and I were growing up, and a lot of you guys were growing up, there were certain things that you never actually did unless you wanted to basically have the sword of Damocles hanging over you socially for life. Yeah. And one of them was a foreclosure. So if you had a foreclosure or if something like that happened, that was a major social no-no.
It was bad.
Nowadays, as a result of the housing crash, if someone has a foreclosure, it doesn't even really, it's nothing. And they had, so the whole mindset and culture about mortgages and housing completely changed as a result of the housing crash.
As equity disappeared.
Right.
And not only disappeared, but people became upside down, meaning they owe more than the house was worth.
And furthermore, the manner in which the government reacted afterwards it also completely changed people's sense of responsibility to paying their mortgage obligations. Because there are people to this day that are still in their houses on essentially long-term mortgage workouts of some variety that are still underwater or maybe just now have enough equity as a result of the housing crash. We knew people that were in their homes for 5-6 years making no payment because of the fact that, there was various government programs that would come out that would stop foreclosures and all the rest of it. So before the housing crash, there were no programs like that. In California, for example, I believe the law was the notice of default had to be filed within 60 days of the first missed payment. Well, it doesn't happen that way anymore. And so people's perceptions about mortgages, and frankly, perceptions about paying their mortgages in the event that they can't make their payment, all of that changed. And that's one of the reasons that the lenders started, in what Julie's about to share with you, tightening up. So there's the lending standards that the government puts in place for most, government approved Fannie Freddie type loans, conforming loans. And then there's what the banks call overlays. So the overlays, just as it sounds, it's another set of rules and regulations that your individual lender is going to put on top of the loans. Moral of the story here is what Julie's about to read to you as far as stats is the complete opposite of how things were. Going back to our original premise that when it comes to reasons to believe that there's not a housing crash looming, reason number one is because lending has never been so tight.
That's right. In other words, there is no underlying systemic mortgage issue that would push things to be a bust. Okay. So I wrote, what's different today? Well, things aren't just a little bit different in the mortgage world. They are dramatically different, as Tim just said, with the pendulum swinging way the other direction. Some of you guys have wondered, why are lenders so strict? Well, we just told you. This is the reaction to it. So point number one, what's different today? 36% of home sales are all cash. That's huge. This is according to CNBC. I like to give credit where my stats come from.
Yes, ma'am.
Okay. In many markets, especially in the Northeast, more than 50% of sales are all cash. You guys know this because you've had to compete with all cash with your financed buyers. Note, there's no lender to foreclose on a house with no mortgage. So that by itself is a huge point why that's not going to go anywhere.
By the way, for those of you who have yet to finish your 2021, 2022, 2023 business plans, your fill-in-the-blank business plan is waiting for you. It's called the Real Estate Treasure Map. And this is something we give to all of our listeners for free. It's our way of saying thank you for being a loyal podcast listener and continuing to make this the number one listened to daily podcast for real estate professionals in the world. So text 2021 to 47372. Text 2021 to 47372. You can do it right now while you're listening before Julie gets to point number two. Just text 2021 to 47372. Nothing's going to happen to the podcast. It's going to keep on playing. You can keep on listening. Hop on, just click your little SMS tab on your phone and just text 2021 to 47372. When you do, we're going to text you a link, and you're going to click that link, and then you're going to be able to download the Real Estate Treasure Map, Think and Grow Rich for Real Estate, and a lot of the great books that are really going to give you a fantastic sense of direction for the rest of the year in your real estate business. So while you're thinking about it, go ahead and text 2021 to 47372.
Okay, so what's different today? Point number two, lenders have tough standards today. Average credit scores for third and fourth quarter of 2020 were a record high of 786, according to the Federal Reserve Bank of New York. 786. Now, that I can tell you for sure was not happening in the previous boom.
Well, they had loans.
Or they wouldn't have those funky loans, right? A lot of people that had not great credit were still getting mortgages.
That's right. And so that's one of the things that if you had bad credit, you would go to a subprime lender. And one of their criteria was they basically didn't give a rat's butt what your credit score was. And they were giving loans sometimes for people with credit scores like 600 and lower.
Yes.
And so, and here's the funny thing, is the subprime market originally evolved to just basically serve subprime borrowers. But as I said earlier, what happened to a lot of these lenders and these loan officers, they were sticking A grade borrowers into subprime loans so they could make more commission. And then they would also say, well, guess what? Now, if you go to this lender B, you can it's a loan where you only have to pay the interest for the first 7 years, and your payment's going to be lower. You weren't going to stay in your house 7 years anyway, so what difference does it make?
We'll get you qualified this way.
Exactly.
Yeah, so not so today. Those borrowers going to get a mortgage today are going to most likely get declined because the product's not even out there. All right, so reason number 3, the competitiveness of the market has also caused higher down payments, yet the actual monthly payments are not dramatically affected thanks to low interest rates. Also a difference. So this means that you automatically have more equity in your home when you close in 2021 than the equivalent in 2006, where you might have purchased with low or no money down.
So this is a good time to interject in there. There's a record amount of home equity. There's never been this much as a percent of outstanding mortgage, or as a percent of mortgage values. There's never, did you get the stat? It's over $1 trillion in home equity. So people right now, you listers with homes, are sitting on a record amount of equity. I mean, Julie just told you the average home in the United States has already increased in cost by $35,000 this first quarter this year. So there's some nice free money for you. You're living in a house where the house is paying for itself. That's a nice thing, right? But the moral of the story is that people with tons and tons of equity don't default.
Well, that's
generally
right.
speaking.
Well, but look at it this way. Even if they were in a situation, let's say that they came off of a forbearance, they haven't gotten their job equivalency back yet, whatever, they've got health problems, they're not going to make their mortgage payment, okay? And they don't qualify for a loan mod. Let's say they miss a few payments. The point you made about equity makes a difference, right? Because just because somebody misses payments does not equal a short sale or a foreclosure, because they can sell the house today, pay off the forbearance, pay off what their past payments, and still walk away with cash.
Yeah, and that's the thing. You guys got to be clear about that. That's a really big deal. So worst case scenario, Julie just said it. Someone can't make their payment, but they're sitting on equity. They could price the house to market, and it's going to sell in 22 seconds. They price the house under market, it's going to sell going back in time in 22 seconds. So that's the thing. That was not the case. Back when the housing market started to crash, there weren't buyers for the houses, so the prices kept dropping. It was a supply and demand issue, basically. And all buyers, the saying was, I don't want to catch a falling knife. That's not the case now, and it's not going to be the case for a long period of time. There are buyers upon buyers upon buyers stacked up to purchase houses in virtually every price range in every market in the United States, and also a lot of the other markets in which we have coaching clients.
Exactly. So point number 4, and this is one that's been kind of ruminated in the press. There's been some videos about it. Forbearances. Well, what's going to happen to all these people coming off of forbearance? Well, we just discussed that a little bit. They have enough equity that even worst case scenario, they're probably going to sell the house and cash out.
But there was also stats we got from Rick Sharga where he was basically, am I jumping in your notes? Okay, sorry.
Okay, so forbearances staved off potential foreclosures during the Black Swan event, another thing people throw around, known as the 2020 COVID-19 pandemic. And no, there isn't an avalanche of post-forbearance foreclosures on the horizon. Forbearances are being extended. Loan modifications and other solutions are the norm now, not the exception. So from CoreLogic, this came from the end of March of this year, recent announcements of forbearance extension by the Federal Housing Finance Agency, known as FHFA, came on the heels of millions of forbearance plans that are about to expire at the end of March under the CARES Act. The new extensions allow additional 6 months stay of forbearance, making borrowers eligible for a total of 18 months of temporary payment relief. Well, guess what? There was nothing that even remotely looked like that in 2006, 7, or 8. Unheard of. They wouldn't do workouts like that. Well, there's no impetus for anybody wanting it to hit the fan.
So there were in 2008 because that's when
there were modifications.
There were modifications, right?
But there wasn't 18 months of forbearance.
No.
Modification was usually 90 days to 6 months.
Yep.
And had a lot of rules and stipulations to it. Okay. So and I'm going to go down to a quote from.
Okay.
Okay, but number 5. Foreclosure activity is very limited. Bankrate.com says in the years after the housing crash, millions of foreclosures flooded the housing market, depressing prices. That's not the case now. Most homeowners have a comfortable equity cushion in their homes. Lenders haven't been filing default notices during the pandemic, pushing foreclosures to record lows in 2020. And here's a quote from Rick Sharga, Executive Vice President with Realty Track, also a friend of ours. Market conditions are nothing like they were during the last recession. And Rick studies this thing probably more than anybody we know, right? So he said there are reasons to be cautiously optimistic despite massive unemployment levels and uncertainty about government policies under the new administration. But while anything is possible, it's highly unlikely that we'll see another foreclosure tsunami or housing market crash.
And Realty Track, by the way, sells default. That's one of their products is they sell default notice information too.
So he would know.
He would know, right?
Right.
But guys, there it is. Now what's the next major topic and why there will not be a housing crash?
I think we're going to do demographics on Monday.
Okay, cool. That's a good topic. All right.
And also really factual stuff.
And again, these notes are going to be posted on timandjulieharris.com, so pop over there and check them out. In the meantime, hopefully you're all feeling optimistic that you are in the right place at the right time in the right industry, so good job past you, right? Now, the next thing you want to consider doing is moving forward with Julie and I at eXp Realty. We'd love to talk with you about you joining Julie and I's eXp group. Now, we just put up a new website you can check out. It's called ylibertas.com, ylibertas, Libertas.com. And you can check out the website, and that's the reason why so many agents are choosing to join with Julie and I with Libertas, which is our revenue share group at eXp Realty. But if you'd like to talk with me directly, if you want to talk about moving forward with your, brokerage selection and to something that's actually going to help you weather whatever storm clouds might be on the distant horizon, please do consider eXp Realty, and please do consider having Julie and I as your sponsor. You can text me directly at 512-758-0206, 512-758-0206. In the meantime, you guys have a fantastic day, and we'll talk with you on the show tomorrow.
This program has been a presentation by Tim and Julie Harris, Real Estate Coaching. For more information on our real estate coaching and training programs, visit our website at timandjulieharris.com. Remember to tune in weekdays at noon for upcoming shows, and until next time, thank you for listening to Real Estate Coaching Radio with Tim and Julie Harris.
This podcast is a part of the C-Suite Radio Network. For more top business podcasts, visit c-suiteradio.com.